Well, Facebook Live, I think we're cooking here. Looks like the updates changed platform a little bit, but I think we're going. Um, yeah, I'm Russ Story. I'm your host of Money Matters here on Wave 94 FM down in Tallahassee, Florida. And also, we're at WDMG, your community station in Douglas, Georgia. So in Douglas, we run this at 11 o'clock every Thursday. And on Fridays at 5 o'clock drive time down in Tallahassee with Wave 94. So thanks for joining us. Appreciate you hanging out with us here on Facebook a little bit. What we're going to do, we're going to talk about several things here, and we're going to get the show started in just a second. So hang with me just a minute. Let's make sure we got everything going. All right. This is Russ Story with Money Matters, your host of Money Matters. It's good to be with you today. Appreciate you tuning in with us, and I appreciate you being on board here for this ride today. We're going to talk about some things. We're going to talk about 3 different issues that I've been thinking about here lately. I just want to talk a little bit about the Federal Reserve and what it means when they unwind the balance sheet. You may have, if you're listening to CNBC, sometimes they'll talk about that. They'll talk about what's going on with the Federal Reserve and what it can mean to the markets like the stock market, bond market, and this kind of thing. So we're gonna talk about that today, and we're gonna talk about active versus passive money management. There's been a debate out there since John Bogle wrote his book, Bogle on Funds, and we're going to talk a little bit about that issue of index funds versus actively managed investments and this kind of thing. We're also going to talk about the pros and cons of diversifying maybe into real estate and real estate investment trust as a vehicle. We're going to talk about that a little bit, and hopefully you'll get something out of today's program that you'll find helpful for you and your family. Again, we appreciate you. If you're a client of ours, we appreciate you. You're one of the nearest and dearest things to our heart. So hopefully we're doing you a good job, and you're willing to tell your friends and neighbors about the services we provide. We'd appreciate that. Got a few announcements, first of all. Some announcements. Before I get into that, I want to make sure you know who you're dealing with. My name's Russ Story. I have been a financial advisor for about 25 years. We've been meeting with clients on a day-to-day basis, sitting down with them, talking about their situation and helping them solve tough financial problems. Sometimes I may have 8 or 10 people in here in a day. Sometimes situations will be different. Sometimes there's different folks have different. No day's the same for me. Nobody has the same issues and situations. Everybody's unique. So one of the things we try to do is always advise from a Christian perspective. We always try and advise based on if that was us in the situation, basically what we would want to happen in the event it was us or our families. So we appreciate you listening today. Money matters, and that's why we're on the radio here today. Got a few announcements. Let me hit those. We got, first of all, I want to remind everybody we're having a seminar down in Tallahassee. And that seminar is going to be September the 28th. It's going to be Thursday night from 6 to 8 p.m. It's going to be held at the Capital City Country Club. And if you hadn't already signed up, I'd encourage you to do so. If you think that some of the things, anything that you'd like to talk about, if you'd like more information, I'll be down in Tallahassee on this date. We're going to cover an awful lot in that 2-hour period of time, and I promise you it's going to be worth your time. You can give us a call and register that way, 877-240-9787. Or you can go on our website, storywealth.com, S-T-O-R-Y wealth.com, and sign up. You'll need to go under the community section and go under the events tab under community, and you'll see Retirement Matters Seminar in Tallahassee, Florida, and you hit the registration button and you sign up. So I'd encourage you to do that. Seating is limited, so but we'd love to see you there. We're going to have a good time and good information, and we have great cookies. So if you've never had our cookies, I'd encourage you to come and try the cookies because I think you'll like the cookies. So, okay. Oh, got a few other announcements. September the 8th, which is right around the corner here. On September the 8th, we're going to have the Allman Brothers Tribute Band up here at the old Martin's Theater, and it's going to be pretty cool. We're going to have Jack Pearson. So if you're a Allman Brothers fan, if you've ever heard of the Allman Brothers and you think they're pretty good, Jack Pearson was a guitar player for the Allman Brothers for quite a while. A little piece of trivia: he was the only guy that I know of that played with the Allman Brothers that actually used a Fender Stratocaster guitar. So that was, everybody else played the Gibsons and the Les Pauls and the SGs. But anyway, so I'd encourage you to sign up for that. You can go on, you look that up on the website. It's called Midnight Riders, and in Douglas, Georgia, September the 8th. Also, the Humane Society on the 30th. They're having a fun run at 9 o'clock a.m. Central Square Complex called Fast and Furious. How about that? Fast and Furious. That's clever. So that's happening, folks, at 9 o'clock a.m. on September the 30th. And their, I think, kickoff is down at the Central Square Complex. So that's a good thing. Let's see. Oh, yeah. We have our children's cancer events coming up. September 23rd, we're going to have the live auction. The day before, we're having a silent auction on September 22nd, which is Friday, and it'll be at the Central Square Complex in downtown, historic, beautiful Douglas, Georgia. So you certainly want to make sure you hit that one. So we got the silent auction on the 22nd, which is Friday, and then we got the regular live auction, which will be Saturday, the 23rd of September, and that starts at 7 p.m. is when that starts. So anyway, all right, let's get on to our really big shoe here. We got different things. We got active, let's see, federal, let's talk a little bit about this. You know, I've been reading a good bit lately, and one of the things I've been trying to encourage my clients to consider is looking at situations now and having a strategy for risk management, okay? One of the things that I know, looking at the market since 1929, if you go back and you look, and I would argue that that's sort of the modern history of our markets, and when we were able to really start sinking our teeth into data and we had stuff we could analyze. The reality is the market has gone up and down a lot. In fact, the market is actually up and down more than probably a lot of people think. Since 1929, on average, the market's gone down about every 3.5 years. It's taken a downturn. That's probably a little more volatile than a lot of people tend to believe now, especially since we've had about 9 years. So it's been 9 years since we've had a market pullback. One of the things I'm encouraging my clients to do is consider some strategies to try and put in place so that we can manage risk. And I'm going to talk a little bit about that in just a second. Well, you know, Trump's in office, everything's rocking along, we're kind of whistling past the graveyard and everything looks good. I'd encourage you to have a discussion with your financial advisor about risk and risk management right now. Things are pretty much at an all-time high or thereabout. One of the things you want to do is you may be in a situation where maybe your situation in life has changed. Maybe you're getting closer to retirement and you're like, well, you know, I'm not sure that I can weather a storm, a financial storm like we had in 2008 or back in 1999. There's been, you know, numerous situations recently that we have a tendency to forget. So one of my jobs is to make sure that my clients are that they're informed, that they're given enough information so that they can make the right decisions for their financial future. I'm going to talk about something here that could be the catalyst for the next market downturn. Russ, you know, do you see something happening? You guys, I just read the reports a lot. You know, we manage millions of dollars for other people, and one of the things that we do is we try to keep up with what's going on in the investment world and the markets and what the Federal Reserve is doing because it can be very influential. things and can affect our wealth dramatically. And so I'm going to get a little bit technical here today, okay, on a couple of fronts. But at the end of the day, hopefully you'll be able to understand and have a little better understanding of kind of what's going on and some of my concerns. So the Fed's big bond unwind may clobber U.S. stocks. And this is written by Rich Miller. And I'm going to go in here, and I've read several papers, several reports, and I'm going to try to give you sort of a synopsis of some of the information so that it might can sink in a little bit and you'll understand. You know, one of the things that may surprise the markets a bit, although they know it's coming, is as the Federal Reserve starts to unwind its $4.5 trillion balance sheet, you know, there's a committee of investment guys who are actively managed money managers and these kind of guys. They don't seem too alarmed right now. But one of the things they talked about at a recent get-together was some of the things that could happen that could really upset the apple cart when it comes to the investment markets, the stock market, and this kind of thing. We hope in the future Trump's going to get his tax cuts through. We hope that good things are on the horizon. And we certainly want to put our clients in a position to make hay while the sun shines. However, we do believe that there's some systemic risk that you can't deny about the market. And the other thing is we try to put our clients in a situation where maybe we can help protect them against a market downturn. There's some ways to do that and some strategies. And we'll talk about that in just a minute. But they believed, this group, that investors are underestimating the trouble that the Fed plans could bring to corporate debt markets and also to the stock market. And I understand what they mean. $4.5 trillion is an awful lot of money. And, you know, what we call quantitative easing back in 2008, 2009, 2010, as the Federal Reserve began to pull debt out of the market, it kept interest rates artificially low compared to where they would have could have been had the Fed not acted. They settled down the markets when they went in and began buying the CMOs and a lot of the mortgage paper, as we call it. And if I'm talking about something here that you don't really understand, hang with me, but I think it's, and I'll be glad to talk with you about it if you want clarification or you're just curious or whatever. But, you know, cutting back could hurt the markets and perhaps the broader economy as the Fed tries to unwind this huge amount of paper debt that they hold. And so one of the things we can really just hypothesize about how the Federal Reserve is going to begin to unwind this huge amount of debt. I know Joe Bean Hurren, he's a credit manager with Aviva Investors. He manages about $456 billion as of June 30th. And he says, you know, cutting back could hurt the markets. He talked about that. You know, the Federal Reserve's gone in 2008. They had less than $1 trillion of mortgages basically are you know, held to by the Federal Reserve, and now currently it's about 4.46 trillion. They hadn't begun to unwind that, it doesn't look to me like. 2017, they haven't really begun to dump any of that on the market. But what that's done is companies' borrowing costs, for example, have been artificially low. And, you know, a lot of people will say that if interest rates rise by about 1.25 percentage points relative to the Treasury, that based on the committee's presentation that I was looking at, then those higher expenses could weigh on stocks. Well, how's that, Russ? Well, if it costs companies more to borrow money and their interest rates higher, then they're not going to have as much on the profit side when everything gets paid off, right? Because quantitative easing has kept interest rates low, has helped corporations fund themselves to be more profitable. Has it been perfect? No, but it has helped the stock market dramatically versus the Federal Reserve not doing anything at all or not taking any action at all. So after years of central bank stimulus, and this is just one of the ways that that the Federal Reserve buying paper, as we say, or assuming the debt. U.S. high-grade companies have sold about $1 trillion of bonds this year, so they've been refinancing at lower rates. Big companies have been helped dramatically by the action by the Federal Reserve. Junk bonds yields are at 4.8%, which is kind of an all-time low, or pretty close to it. So, and of course, we have stock markets at basically record highs. So, the Fed hasn't been buying corporate debt, but as it bought treasuries and mortgage securities, bond yields broadly fell. So, now what did the corporations do with a lot of that money that they had? Well, some was spent to hire more employees, not near as much as we would all like. However, they did use the money to buy back their shares. Well, what does that do? Well, it basically creates another market for their stock, which drives the stock price up on the market. So that's another way that the Federal Reserve has helped buoy the stock market or cause it to rise. So a lot of people hadn't thought about that or really don't understand it in context, and that's what we're trying to do now. So the private sector's been piggybacking on the Federal Reserve's large-scale purpose. So it's caused a surge in borrowing, a surge in tightening of the risk spreads, and this type of thing. So there's a guy, his name's Cummings. He's head of research with Brevin Howard, and they're a big money manager. And he basically says, in an adverse scenario, there's a possibility of a meaningful but not systematically risky decline in both credit and equity. He wrote that on August the 2nd. He's also got a paper there that I'd be glad to share with you if you want to read more about that. Looking at a former Fed governor, Jeremy Stein. He doubted the central bank would be unwinding. He doubted it would trigger a big sell-off immediately, but it's and of course he mentions that cutting back on quantitative easing is designed to be a gradual process. Well, they stopped on a dime, so I'm not sure, but the securities' low-risk premiums and credit spreads are a concern, he said. Jumping around a little bit, credit spreads are unusually narrow right now, and that can be worrisome, says Stein. He's now a professor at Harvard University. Generally, the scenario is followed by widening spreads, credit contracting, and economic growth slowing, he said. Well, that's kind of logical when you think about it. So we have a few things here going, and I don't know what he's basing that precedent on. He said generally, because we really haven't had the type situation that we're in right now. One of the things, we have an awful lot of index funds. A lot of assets are held in passive money managed funds. We have exchange traded funds that are tied to corporate debt that could amplify the pain in the market for company debt. And that's something that Stein said as well. He said when trouble comes, retail investors are likely to bail out. That'll send prices even lower. The Bank of England highlighted in a white paper last month, they talked about the feedback loop between corporate bond prices and fund redemption sales. And one of the things this guy wrote, at some points markets will test the Fed's determination to continue to withdraw stimulus. There was a Morgan Stanley strategist, his name's Adam Richman. He wrote on August 9th, we think investors underestimate the tailwind from quantitative easing in this bull market. They are similarly now underestimating the headwind from reverse QE, he wrote. Well, what does that mean? Well, that means that the Federal Reserve is in a tight spot. They're going to have to be extremely careful as they begin to unwind and sell this paper back to the markets, because that, just as it created the favorable atmosphere and climate for corporate profits, bond prices being high, it could actually do the reverse. It could really tighten corporate profits as cost begins to rise. those buybacks won't be as robust, perhaps, because they won't have the money to do it. They'll be spending more money on debt service. So this could cause a slowing. So I want to talk next about active versus passive money management. And I know you guys are just dancing in the aisles right now. I mean, what I'm talking about is so doggone exciting. I know it's just riveting. But anyway, these are some things that I'm sharing with you that I believe we need to talk about from time to time. There's things going on that you need to understand. You know, the market's been doing well, but it's had a pullback in the last week or two. And it reminds me, and I hope it reminds you as an investor, that trees don't grow to the sky. You know, things do well, things go up, things can, but at the end of the day, trees don't grow to the sky. So we need to understand that there's a cycle. I call it a bull-bear clock. And we always need to be mindful that things can go up and things can go down. So I want to talk a little bit about this raging debate. And it seems that the debate's over with now. We've had 9 years of stock market returns that have been up, and everybody's just sort of whistling down the highway and they're not worried about risk anymore. Well, I'm not. You know, I've been in this business for 25 years. I know what market cycles do. I know the bull-bear clock. It's there. We don't know what time it is. Nobody ever calls us up and says, hey, the stock market's about to go down. You need to maybe make a change. But I want to talk a little bit about that. There's the battle between this stock picking active and index-based passive investment's been around for a while. In 2016, the momentum was all on the side of passive money management. Well, Russ, we just need to invest in the indexes and let things rock and roll. Managers like BlackRock, Vanguard, State Street, they occupy the top spot now as far as assets under management is concerned. They have trillions of dollars in them. Traditional stock picking active managers have been hemorrhaging assets now for the last several years. According to Morningstar, passive mutual funds added about $292 billion in 2016, whereas active managers shed about $204 billion during that same period of time. So those numbers are for open-ended mutual funds. They don't include ETFs or the shift in institutional assets where the same trend, of course, has been underway. So, the leaders of some of these active managers sort of circle the wagon a little bit, and they say, hey, look, guys, we're losing a lot of money. People they don't want to pay for our recommendation, our advice anymore, kind of what's going on. So, people are voting with their pocketbook, right? They're moving to the passive management. So I want to share with you some arguments. There's oceans of ink that's been spilled over this issue, a lot of conversations, a lot of debate. But the reality is, here's kind of a brief synopsis of what people would argue, passive versus active money management. Okay, so passive management basically amounts to this. Excuse me, management fees are close to zero. Okay, you don't have much of a cost. Most active managers don't outperform the benchmarks after fees, so it's a matter of getting what you pay for, and identifying active managers likely to outperform can be difficult. People don't have a lot of that information readily available. And if you read Bogle on funds, it's kind of, he clarifies stuff. Of course, it's shaded to his own benefit. I mean, everybody's got a sales pitch. So now, passive against passive management. Here's the case against passive and for active management. You have passive investing doesn't allow for efficient allocation of capital, many would say. There's no attention paid to valuations, fundamentals, etc. Herding into overbought asset classes is also another issue. An overbought asset class can temporarily and for a season be continued upward and kind of get overbought even worse. So there's no chance of outperforming a benchmark because the benchmark is the benchmark, right? You hope that it does as well as the benchmark, but it's actually going to underperform a little bit because it has some fees typically. So at Story Wealth Management Group, we kind of take we look at this passive active debate, in a little different light. I don't think it matters. I don't think it matters whether it's active or passive. It just doesn't matter. I think what we're doing is we're arguing over a very minute issue, and we're not considering a bigger gorilla that's in the room. Systemic risk is the 800-pound gorilla. I've never had a client come in here and sit down and us have a conversation about their situation and them say, Russ, my financial goal in my life is to beat the S&P 500. I've never had that happen. People come in and they say, I want to send my kid to school. Russ, I'd like to retire in 5 years or 10 years or whatever. Russ, we'd like to take this money and do this, and we want to pass this on to our children, and I want to make sure my wife has an income stream that's equal to mine, or I want to make sure I'm sick, I'm not doing well. You see, nobody comes in here and says, Russ, I want to beat the S&P 500, but that seems to be some great academic debate out here. Now, in my opinion, the debate is focused on the wrong things. I don't think passive-active argument is about relative performance, not absolute returns. My clients are worried about absolute returns. By focusing on the differences measured in tiny, minute basis points, I think we're risking loss of the forest for the trees. Okay, because one thing both active and passive management strategies share is something called systemic risk. Systemic risk, I say again, is the 800-pound gorilla in the room. Well, I think it's one of the biggest threats to an investor's wealth, systemic risk. By definition, systemic risk is risk that cannot be diversified away. Okay, we can't diversify your portfolio in different indexes or in different investment strategies to reduce the risk to zero. So market risk, systemic risk, kind of the same thing, is the price that's paid for being in the game. That's the price we pay for investing. That's the price we pay for the hope and the prayer for our assets going up over a period of time. So how do you quantify systemic risk? What does it look like? Well, here's what it looks like. 2000 to 2002, systemic risk was a loss of about 47.5% from the market peak on September 2nd, 2000. The market bottomed October 9th, 2002. The S&P shed half of its value. Moreover, it wasn't until October of 2006, months after the bottom, that the market recovered all of its losses. That's systemic risk. Only a few years later, systemic risk again reared its ugly head. What happened? Well, if you remember, in 2007 through 2009, the S&P index was down 55.2% at one point. That's what we call systemic risk. So it took March of 2009. Wait, check that. So I think, you're arguing over, a quarter of a point, maybe half a point in return, but you're failing to address the big booger in the room, and that's systemic risk, or that's market risk, because neither one of those do anything to take care of, to protect your investments from that huge risk. So bottom line, traditional stock picking, not able to stock pick. You can't stock pick your way out of a huge market decline. The risk is still there. I don't care how good the manager is. So the market sells off by 30, 40, 50%. The index manager is designed to go down with the ship. That's by design. A passive manager is entirely 100% systemic risk. So it's our opinion that this risk can't be diversified away. But it is my opinion that it must be hedged away. Now that's a story for a different day. Okay, I want to address the issue, but I do believe that there are some ways and some strategies that we can consider that may have a tremendous impact as far as hedging away some of the risk. Now, I can't get into that. During the financial crisis, 2007 through 2009, vast majority of passive and active funds lost half their value in a very short period of time. I think there was one fund out of 1,450 funds that were able to lose less than 25%. So when things go wrong, the relative advantages or disadvantages of active versus passive money manager is really rendered irrelevant. Okay, so you okay, Russ? Well, so what? Well, one of the things we try to do is, if you sit down with us, we're going to share with you some strategies. We want to make hay while the sun shines. Hey, Russ, I'm happy with my 401k right now. It's doing good. I got news flash for you. Everybody's doing good. The question is, are you wise enough to reassess your risk tolerance? Let history be let it be a teacher, and learn from it and move forward with that knowledge and applying the understanding of the knowledge that we have right now? Or are you willing to sit back and allow yourself to take these incredible losses? Is your risk tolerance up for that? I would argue that the older we get, that as we get closer to retirement age, as we get ready to employ and take money out for our particular financial goals, that we need a risk management strategy. We need a way to protect ourselves when the market goes down. And hear me now and believe me later. It's not a matter of if. Market's going to go down. It's a matter of when. So the question is, are you going to be prepared? I talk about the bull-bear clock sometimes when I'm discussing risk with my clients. What I mean by that is 12 o'clock noon is when the bear market starts. It's when the market starts going down. Down it goes. 6 o'clock is at the bottom. When everything's sold off, it's at the bottom, and now things are beginning to go back up. Now, where do you think we are in the bull-bear clock? It's not a trick question, and I don't know. You don't know. But we can allow history to teach us a few things. If I told you every 3.5 years the market goes down 35% on average, if I told you, and it's been 9 years, well, that in and of itself, I think, kind of dictates where are we on the bull-bear. Do you think we're at? I don't think we're at 6 o'clock. So we're probably somewhere between 6 and 12, I would think, because the market's been going up. Well, are we at maybe 9 o'clock? Think we're halfway through this bull market? You think we may be at 11:59 for all I know. In fact, we may have already been past 11:59 because the market's been down here the last week or two. So my point is, please don't forget the lessons of the past. When it comes to managing your money, this is just one issue, one aspect that can really enhance your quality of life. And what we want to do here for you, and I hope every financial advisor that you talk to, is to help your financial life to be as comfortable and as worry-free as possible. So anyway, my name's Russ Story, host for Money Matters. I've gotten down to some pretty boring and deep stuff here today, and I'm trying to provide you with some information as to why I'm a bit concerned about the attitude and the thought process of a lot of folks now as far as risk management strategy is concerned. The older we get, the less volatility we really and truly probably need to accept concerning our portfolio. So anyway, it's been great being with you today. I hope everybody has a great weekend. If you have a question, give me a call, send me an email, rstory@storywealth.com. I'll answer your email, believe it or not. I do it all the time. Just send me an email if you have a question or concern. Give us a call, 877-240-9787. It's been a pleasure and an honor being with you. Appreciate you listening to Money Matters. This is Russ Story, and we'll see you, and God bless.